And the question that I got was from Bo Scales, and he is directly asking, how do I generate stable cash flows when the interest rate is low? And the situation for Bo is that right now the interest rate is 2.06%, and Bo is heading for retirement. So Bo, he is not looking to accumulate a lot of capital at the moment. He has already accumulated some capital, and now he wants to get a decent return. The problem is this: if the interest rate is only 2% and he has, say, $1 million, the return he would be getting is just about $20,000 for him and his wife, and that might not be sufficient. Especially because if you look at something like like bond investing, his income cannot really be expected to increase. So, what should you do now? Now, this is really just a generic advice, and the advice I'm giving here is really to show you the different approaches you can have to what I would call income investing. So what I would like to introduce is a company like Coca-Cola, because a lot of these really big companies, if you choose to invest in them, you would not only be getting like an interest, but you would be getting the dividend, and you can look at the dividend like an interest, especially for these companies. So if I should give you like a clear-cut example, if you look at the dividend yield for Coca-Cola, right now you would get 2.92%. So in other words, if you invested like $1 million, you would not get just above $20,000, but you would get close to $30,000 back every year in return. And you might think that is not really that much of a difference, and you might be right. But what is really amazing about dividend investing is that dividend investing tend to compound much better. So, for instance, a company like Coca-Cola, to my best of knowledge, they have been increasing the dividend by in 53 consecutive years. And right now, I think the most recent data is that they just increased it by 8%. So it's not 8% from like 3 to 11%, but 8% of the current dividend payment. So there's definitely something that you might want to think about. And I would actually like to show you a website where you can see some more information about Coca-Cola and what to watch out for. So this is Morningstar's homepage, and this is the homepage I'm using and I'm mainly using. It's in general, you can get a lot of information for free. You can also buy and get some more info, but I think that for a lot of investors, for the vast majority of investors, they don't need to purchase the subscription, and what I will show you is also completely free. So if you need to search for a company like Coca-Cola, you should go up here in quote, and if you know the stock ticker, all stocks have a ticker, you can write that in. Otherwise, you can just find the name of the company, Coca-Cola, and what you'll see is this screen here. So the number I'm looking for right now is the yield. So there is the 2.92% I was talking about before. And to validate if this is a good number, I look at some different stats. And the first thing I would suggest you to do is to click on the key ratios. There's a lot of great information here, but I will just give you a few pointers. The first thing I would always look at is the dividend payments, and this is this line here. So this is the dividend payments, and as you can see here, back in 2004 it was 50% for one stock, and the trailing 12 months, so that's the last 12 months, it was $1.2. So as you can see, every year Coca-Cola has had the very good habit of increasing the dividend. Okay, so that was the 8% I was talking about before. It's not like consistently 8%, but you might be expecting to get like 3% return, and that can increase over time as well, contrary to the bond payment. The other thing I would like to look at is the earnings per share, and that's just right above that. So the earnings per share, you can see it has been increasing steadily. So even though there was a small slip here in 2011, and it might seem to be going on, it's still, you would see like a fairly steady increase in the earnings. And what I would even more look at is the payout ratio. So the payout ratio is really measuring how much of the dividend is being paid from the earnings. So those 55% here, that would correspond to that 55% of the earnings, for instance, $1.02, that is paid in dividend. So you want a payout ratio that is not too high, because clearly if it was over 100%, that would be bad for you, because then Coca-Cola would be paying more out to you in dividend that the company is making, and clearly that is not a sustainable solution. So I would definitely take a look at those three lines. Another thing I will also take a closer look at is in the financials tab here. So when you look at the financial tab, I would like to compare the interest rate, that is this line here, and this is the most recent numbers, the last 12 months, and this is from fiscal year 2013. And you can see that the interest expense is 463, and this is in $1 million. But what you need to compare this with is the operating income. And the operating income and the interest expense, that is really comparing like how many times can we pay our interest expenses. And the reason why I think that is very crucial is that it's not really enough that the company can pay dividends. It's not enough that they can they have high enough earnings to do that. Because in the long run, if they have a problem with debt, it's really, really important that they can sustain these earnings. So I always like to be sure that the interest expense can be paid at least 5 to 10 times. And as you can see here for Coca-Cola, it's over 20 times it can be paid. So I'm pretty confident in this company here. If we take a look at the numbers again, we can see here that the payout ratio was important. We don't want that to be too high. It's fair enough that a company like Cola might be paying out, say, 50% as a payout ratio, but we don't want that number to be too high, because otherwise there won't be an improvement to keep increasing the dividend payments. Then I would also look at the earnings trend and the estimates if you have access to that, because we also want to make sure that the earnings of this company will grow in the future. If the earnings will be growing, well, that would be a great idea, because again, then they have more money to pay out to the shareholders. And then the final thing we saw was the debt, and we call that the interest coverage. And basically that means that we can pay the interest expenses at least, I said, 5 to 10 times. If you want to be sure, it might be something like 10 times. So what's the downside? I think that would be a very good question to ask, because can it really be so that you should just invest in something that would yield 2.92% instead of 2.06%? I mean, that really seems like a no-brainer, right? Well, if you look at a company like Coca-Cola, the downside is, of course, that you can lose your investment. If Coca-Cola should go bankrupt, then you'll lose your investment. And if you instead invest in bonds, which is the government, there's definitely a slight chance that they will default. But at least in my opinion, if you look at a company like Coca-Cola, I think, without going too much into the details of the company, that if you're only looking for a steady dividend payment, I think that is almost as safe as you would be investing in the government, and your return would be higher, and your potential upside will also be higher.